Bitcoin ETFs, short for Bitcoin Exchange Traded Funds, seem to be at the moment the next great hype and the holy grail for the cryptocurrency community. Investment behemoths like BlackRock, New York-based investment manager WisdomTree, Invesco, Valkyrie, VanEck and Fidelity Digital Assets represent a number of large institutional players that have filed for the foundation of a so-called Bitcoin spot ETF. Yet up to now these have been rejected by the Securities and Exchange Commission in the USA. In today's episode of That Crypto Show, we want to explain what Bitcoin ETFs are, what the difference between a spot and future ETF is, and why crypto spot ETFs seem to be so crucial as the next step of evolution of the crypto space. Before we start, please leave us a like and smash that subscribe button. It's the only way the YouTube algorithm notices us and will give others the chance to also learn important things about the financial markets. ETF stands for Exchange Traded Funds. Now, ETFs have been around since 1993 and they've quickly become one of the most popular investment vehicles for both institutional and individual investors because they often offer a lower cost solution for trading and investing than their counterparts, mutual funds. An ETF is an investment vehicle that allows investors to gain exposure to an asset, for example a stock index such as the S&P 500, by holding all the assets that are also present in the underlying index. Every time the underlying asset moves by, for example, $1, the price of the ETF also changes by $1. Nowadays, you can find ETFs not only on stock indices but on bonds, commodities, forex, specific sectors and industries, and so on and so forth. Besides being often more cost-effective than mutual funds because there are no highly paid fund managers picking the individual assets the fund is investing in, they often also actually outperform their counterparts. Let's take the S&P 500 index again as an example. Over a period of 5 years, 86.5% of actively managed funds, the ones with a highly paid investment manager picking the stocks, underperformed the S&P 500. Over a period of 10 years, this number even rose to 91.4%. So, investing in an ETF that is not only cheaper but also outperforms actively managed funds 9 out of 10 times has become hugely attractive. With the ever-rising popularity of cryptocurrencies and Bitcoin reaching a market capitalization of nearly $1.3 million in November 2021, it of course made sense to also offer ETFs as an investment vehicle for cryptocurrencies to allow more investors to enter the cryptosphere. And yes, on October 19, 2021, the first Bitcoin futures ETF began trading on the New York Stock Exchange. So if there was already a Bitcoin ETF, what is all the hype about now in 2023? Well, the devil is, as so often, in the details. You see, not all ETFs are the same because there are ETFs that base their pricing on so-called future contracts and ETFs that trade the so-called spot market. A Bitcoin future ETF does not hold Bitcoin directly. Instead, it tracks Bitcoin futures contracts, which are agreements to buy or sell Bitcoin at a predetermined price on a future date. In other words, the ETF's performance is tied to the price movements of Bitcoin futures and not Bitcoin itself. No real Bitcoin are held within the ETF, and prices can actually trade at a premium or discount of the normal Bitcoin price due to the process of rolling future contracts at regular intervals. On the other hand, Bitcoin spot ETFs hold actual Bitcoin, and the performance of the ETF directly tracks the current market price of Bitcoin. This is a more direct and pure way of gaining exposure to Bitcoin itself, but it also involves managing the actual custody and security of the Bitcoin, which can be, of course, technically complex. So far, At least for the USA, the Security and Exchange Commission has only allowed ETFs based on Bitcoin futures and has denied dozens of spot applications that have been submitted to date, often citing its belief that the underlying spot market of Bitcoin is subject to fraud and manipulation. In my opinion, this is not a very clear line of argument since the future markets also reflect spot prices. However, as of July 15, 2023, there seems to be a change in tone from the SEC since it's decided to accept the spot Bitcoin ETF application of BlackRock, for example. This doesn't necessarily mean that the application will be approved, but it is a step in the right direction. But why are these spot Bitcoin ETFs potentially so important for market participants? The answer to this is that they can be vehicles for so-called institutional investors to invest in Bitcoin with something that is regulated and monitored. Institutional investors, such as large pension funds or mutual funds, cannot just throw their investors' money at anything they want. They need a firm regulatory framework that they and their investors can rely on. And this would come in the form of a Bitcoin spot ETF. So, once the SEC approves the first Bitcoin spot ETF, this could be the beginning of potentially trillions of US dollars of institutional money pouring into the crypto markets, and especially Bitcoin. A higher demand then probably could be the cause for what all of us are waiting for: Bitcoin to the moon. How do you manage your Bitcoin investments? Self-custody, or do you keep them at an exchange? Leave us a comment and make sure to smash that like button and subscribe to our channel. Until we see each other next time, happy investing.